right? So we have to work on a cash basis accounting process internally from a managerial standpoint to know that I got enough money next week to make payroll, fundamentally. And that's where the cash basis accounting comes into play. It's the simpler of the two types of accounting because it's very simple. I got the money, I record it. I spent the money, I record it. There's no rules around timing versus when it was legally earned versus when the cash came in, as we'll talk about.
This is number one on our text, basically.
Yeah.
The free text.
Yep. Yeah, you'll find that everything on the test ties back into that, correct. It does help us keep our eye on the ball to know, because remember last year when they talked about where we were from a cash crunch standpoint? I'm going to show you in the financial statements why that was the case and how important that was from a standpoint in terms of sustainability for the organization. So accrual. Let's go back to Tracy's patient. Tracy's patient has the baby today. Under accrual accounting, when did we earn that revenue? When the service was performed. Okay? Same way as if you put a roof on your house and you don't pay that roofer for 2 months, that roofer still earned the money today because they performed the service. That's why it becomes so much more complex because of the rules around the process of earning the revenue and or dispersing the cash or dispersing or incurring the liability without dispersing the cash. Because for example, for supplies, we tell all of our vendors net, well, we like net 45, they like net 30. That means that we owe it within 45 days, right? That's a form of, on the expense side, accrual-based accounting because we owe the money right now, but we're not going to disperse the cash for up to 45 days. So it's still a liability on our books right now as soon as I bought whatever that supply is. And that's the fundamental of accrual accounting. It becomes a legally enforceable claim. So for instance, if there was a dispute over the net 30 versus net 45 and a vendor wanted to sue us and argue that we should go ahead and pay them, under accrual basis accounting, they have that legally enforceable claim because they provided the product and we said we would pay them. Okay? It is a very complex process. There's a process in here called fund accounting or actuarial accounting under accrual basis. Now when I was in school, that was a month and a half of 3-day lectures to learn how to do fund accounting under accrual. It is extremely complex. And you can get in trouble in a hurry because you get disputes over timing of the liability claims, typically within accrual basis. Make sense? Will not always match when cash flows in or out. There is a disconnect usually between accrual and cash on when cash actually moves. All right, so the basic framework that we work within is assets, liabilities, and owner's equity. We, as we know, are not what? We are not a for-profit. So we have no owners, right? So we don't send any money. For instance, when I was a tenant, we'd send money, our contribution to Dallas. I always kind of look at it as our extortion payment to the shareholders. But we don't have any owners reported. So the assets are everything we own. The buildings, the supplies that we purchased until we use them, all the equipment, everything. Liabilities are legal obligations that we have to outsiders. So whoever we owe money to, just like you owe somebody for your car, same process. We changed this formula a little bit because we don't have any owners. We don't have this, so it's referred to as net assets. So when you look at the financial statements that are in your book here in a minute, we talk about it, assets always will equal liabilities plus the net assets, or the residual amount of money that's given to us. Net assets in our environment is basically foundational money. So when people are contributing to the miracle process and the foundation and all of that, that's where that net assets comes from. Both of those things have to equal, liabilities and net assets have to equal assets, and they always will, to the penny, when the financial statements are audited. If not, we got to find out where the disconnect is and fix it. All right, so these are your basic 4 financial statements, and you have these in your book here in just a second. We're going to talk about some changes in them to explain them a little bit further. You have a balance sheet. A balance sheet is think about taking a picture of the financial position of the company, your balance sheet is that snapshot at the year end. How did we do? What did we end up in final financial performance? The operating statement is like your home budget. Over the course of a period of time, you have a whole bunch of revenue that comes in and a whole bunch of expenses to go out, right? An operating statement or an income statement categorizes all of that revenue and expense so we can understand where we earn money from and how we spend our money. The statement of cash flows is extremely important because it talks about the timing of cash, and it talks about where we spent our cash or where we earned our cash from, okay? And we're going to go through that in a minute because I want to show you a couple of distinct areas where we had some problems. Statement of changes in net assets, that talks about how they're restricted. So if I give money to the foundation, that statement is going to disclose how I restricted that money if I did. Because I can give money to the foundation and say, I only want it spent on LVAD patients. That's the only reason you can spend that $10 million I just gave you, because I'm very generous. Or I want a new neuroscience building built for neurology or whatever it may be. This statement is going to outline where all that money is and how it's restricted. So the objectives of the financial statements are to talk about the financial position, as we've talked about, and how we flow the cash in or out of the organization. There is a significant limitation. It only talks about what happened last year. It has no idea, when you look at them, what's going to happen next year. When I talked about a prospectus, in that world of investment, if I'm an investor looking to buy bonds, I'm going to be looking at a 10K or a prospectus that kind of talks about where we think the future is going for Palmetto Health and how we're going to respond to that future. So for instance, in that document, because we had the cash flow crunch we had last year when we did the VTIP and everything, that's got to be disclosed in that prospectus to investors to say this is what we recognize and this is how we're going to fix it going forward. And are we on track or are we off track? Are we on track or are we off track right now? What y'all learned last week? From our financial performance targets for 2018, we're off track.
We're off track.
Majorly off track.
16 million.
Got to make, what is it, $19 million
something
to
like
net
that.
out to the projections? So, yeah, so we're off track again. So that makes it, that's where we get, that's where in part, remember they were talking about the investors being a little bit nervous because Greenville's off track too. So that's where you kind of get that nervousness. So financial statements have nothing to do with looking forward. They can only give you what that past performance was. They don't give you any information about non-financial issues. Okay? So if you're in a unionized labor environment, let's move to California, and we've got a contract negotiation going on, there's not going to be anything in a financial statement about where we think that contract negotiation is, unless it has a key financial potential for us. Okay? That would go more in the prospectus potentially, and a lot of people are very leery of doing that because it creates nervousness. But it would typically not go in the financial statements. So you're not going to hear anything about clinical medicine in a financial statement. You're going to read nothing about how value-based reimbursement has changed how we do certain aspects of clinical care, right? Never going to find that in a financial statement. Yep.
That would be more prospectus, like what?
Potentially, but even the prospectus for a healthcare organization tends to focus kind of on the clinical stuff, more on the strategy and the financial outcome of the organization. That's correct. So a balance sheet is broken out into this kind of basic structure. You have within both assets and liabilities, you have what's termed current assets and long-term assets. Current is anything that's can be realized or that we own that's less than 12 months, basically. Cash is a current asset. If we can convert something in less than 12 months, like a short-term security, like your CD at home, you can convert it quickly, is considered a current asset. Our buildings would be considered long-term assets because it would take us a long time to dispose of a Richland building if we wanted to sell it for any reason. And or its lifespan is far longer than a year under the accounting rules. Same way with liabilities. Our bonds are considered long-term debt or liabilities because they're not going to mature for 10 or 20 years, whereas the amount of money on accounts payable or the amount of money we owe for supplies is going to be due within the next 45 days. Okay? that's fundamentally how they work. Anything that's fixed assets, your furniture, your equipment, your building, anything like that is fixed or long-term assets. All right, so let's pull out, turn the page, and you guys actually have the financial statements because these are kind of small. I want to pull out our financial statements, and you actually have two sets because I want to talk about some changes in here. I want you to kind of understand how to read these very quickly in certain key areas. You have with you one that is termed June 30th of 2017 to September 30th and September 30th, 2016, or 9-month statement. This is an interim statement that we produce typically. And then you have the full 2017 cycle, which is indicated for the year ended September 30th, 2017 and 2016. You see both of those? And they're separated, I think, by the blue divider, Tamika, is that correct? Yeah. So what you have here is a balance sheet to begin with. And you'll notice, like I said, it's listed out as current assets, and then in this case, other assets or property, equipment, net, and other assets. That's your long-term assets down there at the bottom of that section. Everybody see that? Okay. So to read a financial statement, we accountants were backwards. Everybody normally reads left to right. We're dyslexic. I don't know. We build everything right to left. So the most recent information is always to the far left. You'll see there. So you'll see the column that says September 30th, 2016. That's the older information. The newest information in this 9-month statement is June 30th of 2017. So what this says from a readability standpoint is that, for instance, with cash, and I want to talk about cash because that's where we're kind of in our biggest focus right now strategically. On September 30th at year-end 2016, and these are in millions, anytime you read a financial statement, they're always in thousands fundamentally. So add 3 zeros to every number, and that's the actual number. That's the way typically financial statements are written. So at September 30th, 2016, we had $41,800,000 in cash in the bank. What is the number 9 months later, June 30th, 2017, after 9 months? 15 million bucks. So in 9 months, we eroded our cash position from almost $42 million to $15 million. Is that a problem?
Yeah.
Yes. It's a big problem. Go past the blue divider to the full year, same balance sheet. So what was our cash position at the end of 2017 compared to the 9-month one? $28,600,000. So we were able, through programs that we enacted and the cost-saving functions we enacted, able to bring that cash position back some, right? Is it still where we truly need it? No, and I'll tell you why. Who can tell me what the daily expense to run this organization is? How much per day does it cost to run this entire Midlands affiliate? Stem to stern, top to bottom, from the 10th floor upstairs to your unit and in between. Every day. $7 million a day. How many days of operating cash did we have on hand June 30th? 2 days of operating cash. Now, does that mean we were about to go bankrupt? No, because I've only showed you one thing. Remember, in a financial statement, you need to take the whole picture into consideration. What was our total net assets on June 30th, 2017? If you read on down to where it's got the double line down there under assets on June 30th, what was our total net assets? $2 billion. $2 billion. So what that says is if we had to liquidate all of those other short-term assets, we could do that. Now read back up to where it says total current assets. $443 million, right? See that? So what that really says is, from a financial, if you read statements, what that says is that the 443 is what's available to us to liquidate if we had to get cash. So read on up where it says accounts receivable and other current assets and so forth. You see in accounts receivable, $302 million. That's money owed to us. So in theory, we can liquidate that. Now, how easily is that in reality to do? Anybody know what our charity care is and what our bad debt is a year? It's in the hundreds of millions of dollars. So it'd be a little bit difficult to liquidate that if we had to, okay? The thing that was propping us up when you get into the net assets in the other areas was our investments. This is why I want you to show you how to read kind of the progression of the balance sheet, to look for key areas around our cash position, where our assets are, and how much current liabilities we owe immediately to people. Is that increasing or decreasing? Okay? Because from a cash position, did we contribute to that downfall operationally? Where do you think most of that cash position got eroded from? Our operations. It wasn't in loss in investments and those other things. It was in operations. So it's important as a nurse manager, and I want you guys to understand the basics of what we're talking about in terms of structure and key elements on these to read. Because when Mr. Dwayne stands up there, Mr. Shane, Mr. Beeman, and says certain things, this is why they're saying what they're saying in terms of survivability of the organization. Because our payroll, $966 million a year, divide that by 26 cycles, and that's how much money we're putting out every 2 weeks relative to that cash position. You can see where timing becomes extremely important, and having a healthy bank account to survive those differences in cash versus accrual timing makes a big difference, right? So, are we in good shape financially, actually? Yes, we're in pretty good shape. Actually, we're going to talk about some ratios here in a minute that kind of show you how to decipher these further. That says, hey, yeah, we're in pretty good position overall. We are. They've done a good job of managing it, but this is why we've been so diligent in talking about how we control labor costs and we do certain things. Because if we continue on the same trajectory, this is kind of where you see that erosion continuing, and we're still seeing that, as you saw in the targets. So this is a balance sheet. If you turn over to the next page, you see a basic income statement, and you're going to see in it under revenues, you're going to see other revenue, and then you'll see primarily the net patient service revenue. Okay. So you have two forms of basic revenue. You have your direct operational revenue, which is what we get from taking care of patients. And you have your other revenue, which is all of the investments that we're earning money on. And that's the 425 down there you see in the June 30th, 2017. Now, to read the expense side, remember I talked about the cash position around salaries and labor? So read in the interim 9-month statement, where were we on June 30th, am I reading the right one? Yeah. June 30th, 2016, you'll see where it says $226,445,000. How much did we increase that amount by to June 30th? $20 million. Remember I'm talking about $20 million and where our labor costs were going up by 20? That's where this comes from. So if you ever look at one of these statements, this is how to interpret what you're being told by the executives in that regard. So you can see where revenue, net patient service revenue went up, right? 60 to 77. But that's still wrapped up in timing issues of being able to actually collect that money, right? Make sense? So this is how you read this. And they're built the same way every time. They're divided into your revenues, and you're going to have two divisions of revenue, your direct operational revenue and everything else from your investment activities. And then under expenses, it's broken down just like your budgets are pretty much, salaries and benefits, supplies and other. And then your depreciation and amortization. Let me ask you this question in terms of amortization. Look at the first 9 months ended over there in 2016 where we're at 57 and then 60 million. And then we went down to 19 and 20, right? Why is that? What did we purchase that year? Hey, y'all, all my Tootie friends over here. Consolidated statement of operations. Yep. I'm reading it upside down. See where that was way high, that went down? We wrote off a good portion of our cost in that regard, because when you purchase a company, you can either pay cash for it, Or you can do some other form of purchase, basically like you buy your house and you write off your interest on your taxes, right? Kind of the same premise. We get to write stuff like that down as a tax write-off fundamentally against our income instead of our taxes, because we don't pay taxes, right? So we get to reduce our income by depreciation. So if they purchase a hospital, if we buy a new MRI machine, all of that gets calculated into the depreciation process, and we get to write that off as an expense. So there is some leverage and advantage to making capital investments and purchases from a revenue standpoint. Okay? But it also gets us into the negative if we spend too much and we don't control costs, then we end up with more expenses than we do revenues, right?
So is that why the labor went up, because when we came on, y'all's payroll?
No, actually, the labor went up for other reasons. We're going to get into those. Really, for us, the fundamental problem we have in part of this class, just to kind of put it into a nutshell, is we have an opportunity to control both our long-term process, but also the effectiveness of our daily management of the labor, so that we don't overspend where we don't need to overspend in that regard. And because that's part of what we're seeing. I mean, we talked about kind of the strategy of nursing, and we need to fix we all know we need to fix our salary structures and those things. And Ms. Swinton has said a couple of times, hey, I think we're pretty good we may be pretty good on labor, is how we kind of use it, kind of thing. It's all in how you manage that daily effectively, as we talk about, and how we build these numbers. Anybody want to kind of guess what our permanent fix is for nursing salary structure per year? It's around $20 million a year to fix permanent recurring cost. That's actually wrapped up in what I just showed you and where we're spending on a daily basis, right? So we have our opportunities to kind of help manage this process in that regard. That's why it's important to understand where and how these numbers flow and how we contribute to that as management in that regard. Okay? So that's an income statement. You've got the net assets. I'm not going to go into great detail about it. You have partially fully restricted net assets, and it basically tells you where that money is restricted and how much is unrestricted and how much is restricted. We don't do a whole lot with that unless the foundation board says spend that money. The cash flow statements will tell you kind of where we've spent our money and how we took money in. So it's broken into three areas: operations, investment, and financing activities. Operations are just that, all of our daily operations. Take care of patients and all the expenses and cash flow associated with revenue from that and expenses associated with that. Investment activities is our portfolio, and how much money we're putting in or taking out based on what we buy in our portfolio. You'll notice down there, purchase of Toomey. Under cash flow from investing activities for June 30th, 2016, right? $87 million for that payment on Toomey. So that kind of tells you we spent cash for the purchase of Toomey, and that's consistent with what you saw in the depreciation and amortization process on the statement of operations. So these are financial statements in a nutshell. And this is actually in Financial Accounting 101. I have to spend a whole semester teaching actually how to really build these. It takes a whole semester to teach these. So I've just taught you a semester in 15 minutes. You guys are some smart people. But I wanted to show you some key elements. I wanted to show you basically what the structure is.